good morning or afternoon, whatever it may be for you. Welcome to the launch of the Taking Carbon Out of Credit paper. I'm Becca Bartholomew. I work with the Climate Safe Lending Network, and I'm going to be your moderator for this session. We're excited to have you with us for an engaging discussion about removing climate emissions from lending to accelerate the transition to a net zero carbon economy. So the urgency for making this shift continues to intensify. Last Monday, temperatures over 100 degrees Fahrenheit were recorded north of the Arctic Circle. And this Monday, new data shows that the South Pole is warming 3 times faster than the rest of the planet. So we can't underscore the urgency of this effort and this work and all of you being part of it any more than that. So thank you for joining us for this urgent and important conversation. This event is brought to you in partnership with London Climate Action Week and is sponsored by Partners for a New Economy. As you can see, this webinar is being recorded and it will be shared with you along with additional materials within 24 hours or so. So while we can't have everyone using the chat and we can't see all of your faces even though we wish we could, we really encourage you to participate by using the Q&A feature that's at the bottom of the screen and submit your questions, and we'll try to get to as many of them as possible today and in the future if we can't today. We also invite you to join us on Twitter using the Twitter handles and hashtags provided on the screen. So you might want to take a quick photo of that. We also have them appearing on some of the slides in the future, but please do make this a wider conversation. So this webinar is hosted by the Climate Safe Lending Network, which is a diverse network of bank stakeholders from across North America and Europe who are collaborating to align bank lending with a well below 2-degree global temperature rise. The Climate Safe Lending Network was started to accelerate a global shift to a climate-safe world with a focus on the leadership required by the banking sector. We'll be sharing more about our work later on. But for now, I want to give you a sense of where we're headed today. So we've assembled a fantastic group of speakers who are recognized experts in various aspects of climate finance. They'll be sharing their perspectives on how together we can flatten the climate curve. We'll present highlights from our Taking the Carbon Out of Credit paper that was released today. And we'll also be discussing how the Climate Safe Lending Network is working to transform global bank lending systems and ways that you can get involved. We really need all of us in this. So that's it for logistics. Let's jump in. I'm pleased to introduce Dr. Simon Zadek. He is the principal of the United Nations Development Program's Project Catalyst, which is advancing catalytic innovations that support accelerated action for realizing the Sustainable Development Goals. Simon is a Sherpa for the UN Secretary General's Task Force on Digital Financing for the Sustainable Development Goals. He is also chair of Financing for Biodiversity, which is a pop-up research advocacy and grant-making platform that makes biodiversity relevant to financial decision-making. Simon, I invite you to join us in discussing what it takes to create real change. And those of you on the listening end, before Simon begins, sorry, Simon, please do post your questions in the Q&A feature at the bottom of the screen. We're going to have Simon and 2 other speakers, and then we're going to be turning to questions, but please start sending them in now. We really want to hear from you. Thank you, Simon.
Brilliant. Thank you, Becca. And thanks to James and the rest of the team for setting this up very timely, and congratulations on the report, which is very useful. I was going to give you a sort of a whistle-stop tour through just a few thoughts on this question of banking and climate. And I thought I would start a few years ago in 2013, where I was party to a conversation between about 40 major banks and a banking regulator, where in private they had been asked to do a first round of stress testing using general environmental criteria of their balance sheets. And they came to the table with the regulator. We went round the table as to see what people said, and basically every single bank said no real problems. We then went back round the table, having asked them whether or not their response would remain the same if we introduced extended environmental legal liability, such that they would be complicit and jointly culpable with lendees for environmental damage. And this was obviously in confidence, and half of the banks said that they would have serious problems on their balance sheet, and a number of them in fact said that there would be real solvency issues for the bank as a whole, very serious. Now, that is not good news, but the good news is that we have moved a long way since then. And today, many banks, and many of them are represented on this call, have taken not just small steps, but large steps in really trying to figure out where climate fits into obviously their broader policy architecture, their leadership statements and advocacy, but most important, their lending policies and practices. And we see significant advances at the methodological level, at the data level, and obviously with a range of different types of toolkits of different kinds, some of which we've also seen set out in the report that is now available to us. And we'll hear more about some of those examples in a second. So since that rather ghastly conversation back in 2013, we have made really quite extraordinary progress in a fairly limited amount of time. But needless to say, and I'm sure you would expect it of me, we have a long way to go. I recently completed a piece of work with Tsinghua University on the likely carbon footprint of Belt and Road countries in 2040. And without guaranteeing the accuracy of the simulated results, broadly, we concluded that left to its own devices, so the current pattern that they were progressing, the carbon footprint of Belt and Road countries, excluding China, excluding India, could be as much as 2 or 2.5 times that of domestic China today. And we then ran the simulations to frame the question, what would happen if every other country in the world, so the US, Europe, China, and so on, managed to go on a 2-degree pathway? And the answer was Belt and Road left to its own devices would still deliver a 3+ degree scenario, not at all to our liking. What does that tell us? Obviously, it tells us that the challenge is great, but it tells us that our friendly neighbor banker may not be the only place we need to look. That there are large consortiums of banks that are funding projects in countries that we have relatively light touch engagement with. What happens in the Netherlands may be sort of important, but is much less important than the many banks around Asia, but also international banks that are funding what happens in Kazakhstan or Egypt or Pakistan or Mongolia or elsewhere. We really need to focus on where the large carbon uplift is really likely to be, and the role of banks as well, of course, as financial institutions in making funds available either to do the right thing or still in the case of many countries to do the wrong thing. And that brings me on to my third point, which is really kind of the future of banks. Now, we're not going to have a long discussion about the death of banks because I'm sure that's not really the subject we've come here to discuss. But I think it would be true to say that digitalization is significantly disrupting banking business models, is creating disturbances that are challenging and create unintended risks, but also brings a host of new opportunities, new products, services, financial products, of course, and services that allow us to customize lending in much more sophisticated ways. Just think, and financial services, the digital finance spin-off of Alibaba, can make a loan to an SME, in the space of 3 minutes with zero collateral, just based on big data and AI, and can interweave into that environmental and specifically climate criteria in assessing not only the solvency risk associated with that loan, but also some of the broader normative positions that Alibaba and Ant have taken forward. We wouldn't have a green bond market if it wasn't for digital. We wouldn't have carbon markets around the world and so on. But I think it is an interesting space to consider how digital drives innovation across the financial community, disrupts some of the ways in which the banking community functions, and opens up new opportunities for us to push climate into the way in which the next generation of lending actually happens. And that brings me to my penultimate point, which is, how do we understand whether banks are able to change and what it takes to change them? And just sort of going back one more moment into not too far distant past, but 2012, another group of banks that I was sitting with, really a completely different group. In fact, a European group of banks where one of them, again in private, made the comment, actually the banks in this country are completely unreformable. They will never understand values. They will never engage with communities beyond the occasional niche organization. The best we can hope is compliance and to persuade them to stop stealing our money. This was somebody who worked inside the bank, and this was just a group of bankers around the table. Again, an extreme view, but I think worth considering. Worth considering because ultimately what changes organizations, what moves them towards the right place is values, is leadership, is culture, and is not the plumbing. So we need sophisticated plumbing, risk metrics, modeling, simulation, all of those things that are required to actually run a balance sheet. But actually that balance sheet has to sit within an institutional culture that really makes sense. And I think we begin to see not only the adoption of climate policies and practices, but clear blue water between some banks that really are stepping out with a real deep values commitment to change, not always knowing where that will really take them, whilst other banks adopting similar policies, not so much through a greenwashing lens, but are effectively understanding this purely through a risk pricing and compliance and perhaps reputational management lens. Now, these two things often look very similar, but play out in very different ways in practice. The latter tends to be short-term, the former tends to be deeper, embedded, and long-term. And we can see this not only within the financial community, but across many different parts of the business community, this difference that has proved critical in the sustainable business agenda. So in conclusion, we've come a long way. We've had really bad news in the past, and that bad news has not completely gone away, but we now have leadership and exemplar that takes us to a new place. Secondly, we need to understand that solving the problem, and I'll say here, since I'm sitting in Amsterdam, may not be the most important place to work. We need to look at where the real carbon risks are, understand the banking communities that are lending in that area, and really focus on the work in which they're doing. Thirdly, the whole digital revolution. We need not to think about the way banks were before with a bit of added compliance, but we need to think more about the way banks are going to become, and more broadly, how banking services are going to evolve, supported by digital innovation. And finally, let's not forget values and leadership. Sounds fuzzy, may seem strange, but ultimately it will be the driver of what makes banks of tomorrow align to our climate needs and outcomes. Thank you very much.
Thank you, Simon, and thank you for so wonderfully modeling staying on time. This is great. I really appreciate your thought-provoking comments. Now I am honored to welcome Sandrine Dixon-de Cleve to add her perspective and further spark our thinking. Sandrine is the president of the Club of Rome, as well as a senior advisor on climate change, sustainability, innovation, and energy. She has over 25 years of strategy and policy experience within the UN, EU, and private sector. Sandrine, I invite you to join us in sharing your thoughts on this and how we can move toward a net zero carbon pathway for banks. And again,
okay.
network members and attendees, sorry, Sandrine, just don't forget to add your questions in the Q&A feature at the bottom. Thanks so much. Welcome, Sandrine.
Wonderful, Becca. Well, listen, for some reason I can't seem to put my video back on. So whoever, there we go. The host is now going to do my video. Okay, great. Thank you to Simon for setting the tone. And I think I'm going to build on what Simon ended with, which is the leadership in value-based banking. And in particular, coming from the perspective not only of the Club of Rome and the fact that for the last 50 years we've been speaking about these issues, and the fact that we had limited time, and of course it's a shame that we've still been speaking about them for the last 50 years, because clearly now we can see a convergence between the tipping points of climate, biodiversity, and also health crises. But I think what's important here is to see that we are seeing very much a shift in the last few years in the finance sector. And the question here is obviously, what is the role of the banking sector within that? And as Simon indicated, there is a real need to renovate and revolutionize the banking sector. But I think coming out of COVID, I do want to make one remark, which is if the banking sector cannot step up to the plate now and demonstrate to people that actually they are their interface, they are their pathway to making the right decisions and also safeguarding their livelihoods, then I think they've lost a trick. So that would be my first call. And I believe that this starts with developing the type of networks that we're seeing right now, not only in terms of ensuring that actually we are moving towards climate neutrality in terms of our banking practices and our lending, but also that we do so in a much linked up approach in terms of both social finance as well as climate finance, as well as natural capital finance. What we're seeing in the finance sector, which is extraordinary, and in particular on the regulatory side, we're seeing a link now between those converging tipping points. One of the roles which you didn't mention, or maybe I didn't hear it, is the fact that I've been actually chairing the manufacturing sector task force for the taxonomy group under the technical expert group of the European Commission for the last 2 years. And what we have seen through the development of the taxonomy, as we've been focusing predominantly on green, is the way in which we can actually work with the banking sector to ensure that actually we're giving the right signals with regard to projects at all levels, so smaller all the way up to much larger projects in terms of what is green. And we know going through that process that we need to bring in social indicators at the same time. So I think that this value-based aspect of banking is fundamental, and that if we're going to focus on decarbonization and lending towards greener projects and low carbon projects, we also do so with a view in mind that we have social indicators and other indicators as we move forward. And this, of course, builds on what the UNPRB is doing and the GABV, so the Global Alliance of Banking for Values. But again, I think we need to up it. We need to up the scale. We need to ensure that we put in place the lending criteria as soon as possible, and that it's not only done through regulatory frameworks, but that the banking community comes together and agrees to these criteria under this decade of action, which is fundamental if we're actually going to meet our climate neutrality aims. If we look, however, at the action on the ground, we can see that, for example, in the call or the race to zero with which the UNFCCC and the champions have launched also through London Climate Action Week, there are no banks yet that have stepped up to the plate. And so it's incredibly important that we bring all the banks together to demonstrate that they really are part of this climate safe lending network, but that also they're looking at the rest of that value-based lending portfolio, which brings in the social implications, as I said, and also the natural capital implications and biodiversity loss. And I guess my last point would be around this, and this is based on the conversation that we led with Triodos and James and myself and others yesterday, around the fact that actually, originally, we thought that everything had to be done at a very grand, scaled up international level through the MDBs, through state funding programs. But we're now seeing that actually local lending and the shift within community frameworks, hence the need for banks that are doing the right thing, is fundamental. And so it's these local business models and spraying up rather than trickling down, which is actually going to really shift the way in which we look at our projects and we look at investing not only in infrastructure, but small and medium-sized enterprises that have been so hit by the COVID crisis, and that will be the ones on the front lines and the most vulnerable as well when we actually look at climate crises and other crises and pandemics as they come forward. So I'll leave it at that, and I hope that we have a good discussion as we move forward.
Wonderful. Thank you so much, Sandrine. Really appreciate you bringing in those additional perspectives. I'm now pleased to introduce James Vaccaro, who is the Interim Director of the Climate Safe Lending Network and the author of the Taking the Carbon Out of Credit paper. James is a strategist and systems thinker with a background in sustainable finance. He has over 20 years of senior management experience in sustainable banking and investment, and acts as a special advisor to Triodos Bank. James, thank you for joining us, and thank you for sharing more about taking carbon out of credit. Congratulations on it being released today. And all folks, don't forget, add your questions. This is your last chance. We'll be turning to the Q&A section after James's remarks. Welcome,
Thank you, Becca. Thanks, Sandrine and Simon, for those opening words. Just to kind of start in terms of why did we put together this report on taking the carbon out of credit, we really wanted to address three questions. There's a lot of papers and thoughts on climate finance already. We wanted to know, what is it that banks can really do to demonstrate leadership in addressing climate change? And that means unpacking how does managing risk relate to managing impacts and setting targets. And very specifically, as a strategist, what are the practical strategies that lending institutions can adopt and implement that are going to really accelerate the transitions of their clients, of new solutions, of their own balance sheets, and ultimately of the economy. So that is that's the genesis of the report, and we've laid out is these 5 key sections which are in the paper, starting off in a grounding for taking responsibility for climate risk and the integration of risks into banks' processes. But then the other side of the coin, and perhaps the less talked about one, the accountability for climate impact. So really, what is it that banks are doing which really impacts the climate? Then specifically focusing on stopping the flow of finance to fossil fuels and those things which are creating the climate problems, before really going into the core of the paper. So what are the strategies which will help to decarbonize balance sheets and economies, and how do we finance innovation for a sustainable future? So those are the elements of the paper. Let me start with the responsibility on climate risk. There's a lot of initiatives in the last 5 years since TCFD, the Task Force for Climate-Related Financial Disclosures, kicked off, about really being able to understand and break down where do the physical risks and transition risks occur in a balance sheet. And in particular, how do you integrate some of those ESG risks from things which are happening from the outside environment and from climate change into risk models. What's interesting, and this graph from GARP and the GRI Risk Institute, which only came out last month, demonstrates that by and large, and this was mostly from lenders, is that by and large firms do have an awareness of climate risks. And in fact, about 90% of them have got their boards with an oversight of climate-related financial risks being discussed on a regular basis. However, when you ask those same firms, do you have a strategy that's resilient in the long term to climate change? looking out sort of say 15 years to 2035, about 90% of them say they don't. So somewhere within that awareness, there is a strategy gap, which is not sufficient to be able to manage the systemic risks or to protect those banks in the long term. And ultimately, this comes down to a question of purpose, because the TCFD framework and integrating ESG is absolutely necessary for banks, but it is not sufficient for the planet. And by looking at the next phase, so taking accountability for impact, may be that it's necessary for the planet, but it may not necessarily be sufficient for banks unless there's a really good strategy. And that's really what we wanted to unpack. So moving on to accounting for climate impact, and there are various methodologies, and we're not setting out as sort of this isn't a methodology or a technical discussion, but this is one which is being put forward by the Partnership for Carbon Accounting for Financials. This is from the Triodos Bank annual report last year, which just shows what's possible now in being able to say, here is our balance sheet as represented by the greenhouse gas emissions, what's being emitted through clients, what's being sequestered in certain ways, for example, in natural capital solutions, and what's being avoided through things like renewable energy. And every bank right now, no matter what specific methodology is adopted, has got the potential to adopt to account for its full climate impact right now. And by analysing this sector data, you can find hotspots of where are the specific areas which need attention, and that can provide focus for strategies. So you can particularly pinpoint sectors and groups of clients. So then, in terms of once you've got that, where are the largest areas, taking the flow to fossil fuels, and those are the most damaging sectors, we need to look at the honest conversations that for all the good positive solutions and climate commitments for new positive funding in all the areas which are now becoming mature in renewable energy, in the hydrogen economy, in natural capital, we do need to stop the flow to fossil fuels, to deforestation, and to the things which are really causing the problems. You saw leadership by the European Investment Bank last year announcing that they're going to be ending fossil fuel finance from the end of 2021. It's for those who are continuing, what is the real question and the challenge? Can you effectively now put the pressure on clients, and there will be some who are going to rapidly transition out of fossil fuels. You've seen companies like Ørsted make the transition. Companies across the economy are making rapid transitions. Volkswagen this week made its last internal combustion engine vehicle. But for those who are recognizing that it isn't going fast enough, what is the ultimate sanction, and how at a certain point do banks have to recognize that if those clients are not moving fast enough through incentive, then needing to divest from them is the next consequence, which ultimately chokes that flow of finance for any expansion. We've set out within the paper a threefold sort of strategy, a three-horizon strategy for how to connect together the different elements which we mention into a sort of a series of, well, what do you do? How do you move through this? So we start with understanding and locking down the climate impact assessment. We move through getting some targets being set, and you're seeing more banks now issuing targets, and science-based targets should be available later on in this year. But then it's pivoting to this three-horizon strategy of really being able to throw on the brakes for finance flows to fossil fuels and deforestation, to being able to look at how banks help their clients to accelerate in decarbonizing the balance sheets, and specifically growing these new seeds, which is where all the opportunity exists for banks commercially and in terms of impact in financing innovation and drawdown. So from this kind of overarching broad brush, we decided to create a strategy toolkit, which is a set of provocations. This is not the last word on how you do this. This is a set of thinking tools. And what we're really interested in is for banks who say, we've got ideas which are a little bit like that. We'd like to collaborate with others on doing something like that. We are trying something like that right now and like to share some of our experience. That's what we want to bring in through this network and for others to be able to share insights, to be able to support and accelerate these pathways. Just to give you a quick canter through some of the ideas which we have here. Decarbonisation plans are things which can be set for a whole bank, but specifically putting pressure on clients to be able to help them with forming their own decarbonisation plans. Mobilising client networks, so where there are partners or specifically other companies who've gone through this, that you can connect those up to be able to mobilise action. So that's good business development as well as pushing forward action from a client perspective. That there's scalable interventions which can be also be part of the innovation strategy. So how can we look at specific sector teams working on sector-based strategies? Supported from the underneath by greening operations and getting people involved from across every level of the network, and specifically spreading the word around in campaigns, public advocacy, and what lobbying looks like for public policy and public finance. On innovation, there are a number of initiatives looking at new business models, thinking about how banks can be part of that. How can we accelerate this race to net zero? And this will be sector strategies which banks can get involved with, because banks will provide the major scale for all of these. And this is the opportunity to lead the transition in these new markets. And to close, it's really sort of something which we want to think about, a new valuation mechanism to say, what defines a AAA bank for the future? A lot of things might be quantitative, and people like the quantitative. The little graph behind there, that's the Lehman Brothers stock price before the last year of its existence. But in the qualitative aspects of how well able are banks to anticipate risk, to add value to their clients in transition, and to really proactively act now, those are the AAAs that we see. It's about asking how far and how fast they can go, and specifically in the broader context, figuring out how this transition is going to be made from a perspective of social justice. And I'll close there and talk a little bit more in the Q&A perhaps about the model that we have for interacting with other stakeholders in that path.
Fantastic, James. Thank you so much for laying out all of that. So we're now ready to turn to questions. Thank you all for submitting so many great questions. I'd like to invite my colleague Lydia Haskett to join us. Lydia co-leads with me the Climate Safe Lending Network's Learning Lab, which you'll hear more about later. She's also the head of entrepreneurship at the Finance Innovation Lab, and she'll tell you more about that later. So I welcome Lydia. She's going to share some of the questions. Obviously, we can't get to all of them here, but we hope to continue the conversation after this.
Lovely, thank you, Becca. So James, Sandrine and Simon, if you wouldn't mind popping your video back on. There has been some wonderful questions coming through. I'm going to try to synthesize some key themes, and if you could perhaps try to respond within 1 minute each to one question that I'll direct to each of you. So Simon, your video's just come on, wonderful. Let's start with you. So we have this wonderful toolkit with a range of strategies that banks can implement, and you mentioned that having an institutional culture to support that is a really, really important part of this piece. What would you say are some of the first steps that banks need to take in creating the type of culture that can support these kinds of strategies being implemented at the pace and scale that is required?
Thanks, Lydia. So I'm not sure about the first steps because I suspect that's a delousing mechanism. But let me talk about maybe the nth step, which is a little bit further down the line. The part of what TCFD has helped to advance is to design scenarios that extend time horizons and draw macro systemic factors into portfolio analysis. And however sophisticated your project-based risk pricing is, if your time horizon is too short and you're not looking at systemic factors that deliver highly correlated outcomes, then you will consistently get it wrong. Yeah, and so without getting into good scenarios and bad scenarios and right scenarios and wrong scenarios, banks need to develop their systemic analytic capabilities and understand more clearly how that affects the analysis of their portfolios. And without doing that, there is nothing that you can do at the project analytic level that will make much of a difference. So I would say that's kind of number one. I think the leadership point has been made throughout, but if you'd allow me, Lydia, I just want to put a sort of momentary edge on it, which is, many people have come to me over the years saying, what should I do in my company? Not necessarily banks. And my answer, not intended facetiously at all, is first of all, decide whether this institution is fit for change. Yeah, because the reality is that many corporations will not make it through the transition. And that, the energy one puts in needs to be focused on institutions that are capable of change. And not all are. It's a myth, the idea that all can. Look at the leadership. Understand the culture. Think about whether your efforts working inside a bank are really well used, given what the potential is to leverage them into a different place. And the truth is, and we see that with younger generations of really leading players, is that if it doesn't make sense, actually it's the exit voice that counts best because your energies are best placed elsewhere.
Wonderful, thank you. A challenging provocation there. Sandrine, we have a number of questions around the local strategies and local lending that you mentioned, along with the social indicators. What is a frame that you can share for thinking about those things as part of the climate agenda, as opposed to something extra, another thing that a bank has to think about, the social part, the local part?
I mean, I think this is a really good question. And to be frank, I don't think there is yet a clear framework that takes all of them together. In fact, if you look at the feedback that we were getting yesterday, it was more the fact that we also need to learn from what the social impact banks and social impact investors have been doing, as well as now turning into the investments we're putting into more health-related system shifts as well. So I couldn't pull out, and maybe James has some ideas in terms of a specific frame. It could be that the frame and the toolkit that you actually have could be actually adapted to bring in those convergence of values, which I think is now fundamental, especially for the more ethical-based banks that are trying to think now of all three together. But I would say that there is a general shift, and this is what's important, that we're now realizing the importance of local investment. And that's what I was trying to say. So if we look at the question also on the ECB and the central banks, and the focus that we've had at the MDB level and the large institutional shifts, which are necessary, and we're starting to see some of those shifts, whether it be led by Carney when he started to speak about stress testing and risk management, or whether it be through the EIB divesting from fossil energy, which is fundamental. But we haven't seen yet a real broad-based shift within the local banks, the smaller banks, and even some of the larger banks in terms of the way they're looking at these big issues which are converging. So decarbonization, biodiversity loss, so investment in natural capital projects, nature-based solutions, as well as now what I call the real social human health element. And I'm not sure there is a frame out there. James, I'm going to let you build on that. But I mean, maybe through the experience that we've brought to bear from some of the work that the responsible banking community has done, there is an idea, but it's not yet clear, at least in my mind, as to what I should be promoting. Now, clearly, yes, someone who's just said the EU taxonomy for sustainable finance is such a framework. It is and it isn't. It hasn't yet focused on social indicators. It has focused on green only. Now, it could be a framework once we finish that work and we bring in the social indicators, which is what needs to happen. We build out the do no significant harm criteria, and we also look at what we're calling non-green. Some have said we shouldn't be using the word brown, so let's be very careful, especially in this day and age. But let's look at non-green indicators, because the green indicators in the taxonomy do not bring in all of the non-green criteria that we need to start really pulling out of fossil energy and other investments.
Lovely. Wow. Thank you. James, any final thoughts to add to that very big topic?
Well, maybe just building on it, because I think that there's two things I'd say about frameworks. It's like life would almost be a bit simpler for the more mathematically minded if context didn't matter or didn't exist, but it does. And we've all got different starting points and different solutions. When you go into natural capital solutions, it's not just all one size fits all, but there are certain ways which you can have a certain mindset towards it, a certain orientation, a certain perspective that it's about being able to keep risks managed, but really looking at the whole spectrum of impacts. And that's where this is not a complicated deterministic problem, but a dynamic, complex problem, which requires a kind of sharing, which we have within Climate Safe Lending Network and want to spread more widely. I think the other thing about frameworks is we can get so hung up on there being the perfect framework that it becomes the perfect excuse to delay and defer action. And in the UN Principles for Responsible Banking community, of which I've been part, it can be quite a lot of agonizing about finding and ensuring that there's the perfect way of measuring before you can bridge to action. And really what we're trying to kind of push forward here within the paper is we cannot wait for it to be perfect. It will always be imperfect, incomplete, and impermanent. The point is to be able to be awake with it, conscious with it, adapting with it, with that mindset, bringing the best that an institution can be towards impact.
Thank you so much, James and Simon and Sandrine, for these great points. I know we didn't get to all of your questions. As you may see in the chat, we'll be putting together a Q&A document to follow up after this. So thank you all to our speakers, and thank you to our network members and other attendees for the great questions. Really appreciate this context setting of the big picture. So now that we've got a sense of those big picture topics, we're going to dig further into some of the topics that are in the Taking the Carbon Out of Credit paper. And so we'll have two short panels, and you'll have an opportunity again to submit questions as we go along, and we hope to get to some of those today, and if not today, certainly in the follow-up. So to begin with, we're going to start with a focus on target setting, climate risk, impact, and investment. And to share their deep experience and expertise in those areas, I'm joined by Lauren Compere and Catherine Howarth. Lauren is the Director of Shareholder Engagement at Boston Common Asset Management and is also a design team member for the Climate Safe Lending Network. She has almost 30 years of experience in the responsible investment industry, including global responsible investing. Lauren sits on the board of the Interfaith Center on Corporate Responsibility and serves on the Business Ethics and Systemic Risk Committee for the International Corporate Governance Network. Busy, busy Lauren. Catherine Howarth is Chief Executive of Share Action, which is a charity that coordinates civil society activism for responsible investment across Europe. Catherine is a board member of the Scott Trust, owner of The Guardian, and serves on Her Majesty's Treasury Asset Management Task Force. Lauren and Catherine, please join me in discussing the role of banks in target setting, addressing climate risk, and progressing along the pathway to climate safe lending.
Great. Can you hear me okay? Yeah, good. Great. Well, thank you so much for this invitation to be part of this brilliant event.
The first thing I want to do is just really commend to everybody the new Taking the Carbon Out of Credit report. It's a really strong piece of work that every banker and every stakeholder of the banks needs to read. And I particularly like the 10-part strategy toolkit, which is such a handy, such a strong summary of what needs to be looked at in the banking sector. So thank you for that. Just really briefly on what ShareAction's doing in the space. It's a kind of three things that we do. First of all, we're ranking banks, particularly European banks, on their climate performance. Secondly, we're using shareholder activism to push for progress in the European banking sector. And thirdly, we're kind of equipping banks and investors in the banks with kind of research on particular sectors and areas like the cement sector or the shipping sector, where there's a real need for bankers and their investors to understand what the transition pathways looks like. So, and I just wanted to spend a moment on a really interesting project we've been involved in this year, which was the filing of a shareholder resolution at Barclays Bank. Barclays is Europe's highest carbon lender, and there's a lot of carbon to be taken out of the credit and loan books at Barclays. So we set about a shareholder resolution, and I just want to draw a few lessons out of that experience. By the way, I think it's very important to say we're midway in that journey. It's early days, but Barclays has moved really fast, really far, and it's, I think, evidence that banks can move quite aggressively to change their whole approach to climate change if the impetus is there, if the pressure is there. And the pressure needs to come from, I think, one of four places. It needs to be regulatory, first and foremost. It's just critical that we have the regulation and the supervision of banks that focuses on this, and we're beginning to get that. It needs to come from banks' investors, both shareholders and bondholders. It needs to come from civil society because banks listen to those stakeholders. And it does need to come from within, and all the points on leadership are really well made around the kind of leadership at all levels in banks that are needed. But when we get that combination of pressures, things can really move. So I'm really quite encouraged by that. On the other hand, I would say it's also still really early days at Barclays, and much of the detail still needs to be produced. And the big area where Barclays showed the greatest resistance, and still does, is around phasing out high carbon lending, phasing out financing for fossil fuels. In short. And I think it's just super important that we focus on that, because there is a tendency in the banks to say, hey, look, we've got a whole new green lending strategy. Bingo, we've solved this. And the tough thing is focusing on phasing out of fossil fuels, phasing out of high carbon lending, where, you know, banks have historically made a lot of profits. I want to just focus in saying that on this moment in time, we are at a extraordinary moment in time in terms of the COVID-induced global economic shakeout. And the fossil fuel sector is in a tricky place right now. And it's an absolutely kind of incredibly important moment for the banking sector to take stock, and for all of bank stakeholders to take stock and say, how do we move out of this moment without refinancing fossil fuel companies that have been damaged and are more vulnerable as a result of this crisis? This is an inflection point that we can take advantage of. So just really quickly on the risks and target setting in our kind of
sorry, Catherine, just for time, because I want to make sure we get Lauren in. Can I have you address that in the Q&A part?
Sure.
So sorry to interrupt.
Absolutely.
Lauren, can you take a couple more minutes and share with us what you wanted to?
Yeah, absolutely. Thanks. I want to build on Catherine's comments and the fact that even in our last banking report, we only saw, even though 60% of the banks were actually conducting assessments, it didn't actually lead to changes in business practices. It didn't change. Change or result in changes to sector-specific guidance or new restrictions. And so this highlight and real focus we need to have on no new fossil fuels is incredibly important and part of the decarbonization pathway that the coalition and network are highlighting. I also think since Paris, we've seen over $2 trillion in assets go to new fossil fuel financing, including in expansion financing. So I think that if you were looking at the 10 steps of the pathway that we're defining in the Climate Safe Lending Initiative, we really need to focus on two. One is the decarbonization plans and client engagement. And we really need to move from conversation to actually incorporating this into loan covenants and potentially having default mechanisms within the lending for borrowers. I want to just say one final point that really links Simon and Sandrine and James as well. We context is important, sentiment is important. And so the perfect climate scenario analysis that a bank is conducting doesn't really take that into consideration sufficiently. As an investor that has gone fossil fuel free, we don't feel we need to be at the table engaging oil and gas because we feel that our efforts are best spent in focusing on the transition. I want to say that there is data, and data is important. But if we take into account regulatory trends and sentiment, coal is dead, natural gas is not the transition fuel it was 5 years ago. Renewable energy costs less in most markets than fossil fuel, new fossil fuel expansion or financing. And so I think it's really important that banks really take sentiment, public sentiment, into consideration as they're looking at creating the culture that is needed to really support transition.
Thank you, Lauren. Thank you, Catherine. Really great points, and we'll have you back shortly if we have time for the on-screen Q&A, and if not, we'll add your voices to the follow-up. Thank you so much. So now we're going to turn to strategy and innovation, and to do that, I'm going to invite Ivan Frischberg and Anders Langworth to join me shortly. Ivan is the Director of Policy, Sustainability Banking, Policy and Sustainability Banking at Amalgamated Bank. He's also a design team member for the Climate Safe Lending Network. He has more than 25 years of public interest advocacy, organizing, and policy experience, and is a founding partner of FSC Partners, a climate consultancy. Ivan is a senior advisor on climate for Organizing for Action. Anders is head of Group Sustainable Finance at Nordea, where he oversees the integration of sustainability into internal operations, business activities, and investment, financing, and advisory products. Anders is also the founder of Bankers for Climate, which is a climate change movement for global financial industry professionals. Anders also serves on the Global Banking Committee for the United Nations Environment Program Finance Initiative. So Ivan and Anders, please join us. And others, don't forget to add your questions. Welcome.
Hello, Becca.
Thank you for being here. Go ahead, Ivan.
Oh, okay. Well, thank you all. Let me pick up on what Simon had started, because I'm very interested in his starting analysis and taking a look at what has changed that gives us optimism, because I feel like the starting point is very much that we are not in a good situation. Largely, I would characterize our situation from the banking sector as failing. We know from the report where James cited the World Resources Institute study that most banks are globally below the line in terms of clean versus dirty. That means they are essentially, we're washing our antibiotics down with cigarettes and scotch at too large quantities for us to actually recover. We know that we are continuing to fund fossil fuel expansion at an alarming rate, locking in emissions that we know guarantee in excess of 1.5 and 2 degrees. A central problem that we have yet to wrestle with is the issue of growth in the banking sector, which is a complete and universal ambition for every institution that's out there, but is incompatible with many of the sort of realities of what we need to do in terms of a low carbon society. In part, that comes down to innovation and technology, which I'll get to. But the first piece of the report, I think that's important to emphasize the sort of basic actions that banks need to take and systems is the pathway of measure, disclose, and align. So measure emissions, disclose it, and align. And we believe that is through the Partnership for Carbon Accounting Financials, Carbon Disclosure Project, and the Science-Based Targets Initiative. Whatever you do, though, that basic infrastructure of alignment is critical. When it comes to innovation, there's a new IEA report that's out that looks at the status of technology that we need to decarbonize. And 24% of that is in demonstration or prototype phase, and 41% is in early adoption. So most of the technologies that we need to be able to do to get to net zero are not really ready for large-scale capital deployment. And that is one of the big problems that we face. So I feel like we have a few things that we need to do. The first is that coming out of this crisis, from a public sector position, all rebuilding needs to be done with green infrastructure in mind and with climate resilience and adaptation and mitigation in mind. So we have to rebuild out of this moment in a way that is climate oriented. We are not doing that in the US by any means at this point. The second thing is that we are going to need copious amounts of blended finance. So both public and philanthropic, to be able to leverage private capital and get to the point where we are tapping into the technologies that we need before they're really ready for full-scale market deployment. And then, along with that, we just need to change our public position around price supports and subsidies to allow us to get the pipeline of projects and infrastructure that are really going to sort of rebuild our way out of this problem. The banks currently are not set up to do this as market-driven entities. They don't have the current leadership. They don't have the compensation or structural pieces in place to solve this problem for the most part without significant policy and public investments to redirect and unleash the capital that we need. I'll leave it at that.
Thank you so much. Anders.
Ivan, thank you, Becca. Interesting thoughts from across Atlantic, and perhaps we have progressed a little bit more in Europe and the Nordics, but still a long way to go for us as well. I will try to tap into both the strategic approach and also a little bit on product innovation. And when we look at the strategic approach just a couple of years ago, it was basically having a few products and to do company analysis and having management commitment in a few areas and a few levels. It was a good start, but that's absolutely no way near enough, and that's not what will shift the needle. And I think like many of the previous speakers has addressed, I mean, looking what we are going through, I would say the last 6 to 12 months, but even more now going forward is the speed and really setting a holistic direction from the top management, not just having it in a few certain product areas and integrating it into the main tools. We're talking about integration in advisory tools. So as a good example, last year we integrated a question about sustainability preference in the advisory tools used for all our personal banking customers. And since then, we had 400,000 sessions, including sustainability in the savings advisory. And it's so obvious that when we do that kind of thing, not just having a few products, but actually putting it into the advisory tools, the advisor's knowledge increase a lot and the interest from the customers increase even more. So then we're starting to see a main process tap in and some impact. And even more than on the banking side of the core. Now we have a new ESG risk appetite statement. We're tapping into the risk frameworks and processes and governance. We're doing sector and portfolio level analysis. And that's just during the last 12 months. So it's still early stage and it's still immature, but that is the key, and I would say the only way to do this for real. If we don't tap into these core banking processes and make sure that we get the right data to do all this modeling and do all the analysis and do all the stress testing, then we will not be able to understand if we are on a pathway towards a 1.5 degree scenario or not. So that is basically the essentials of what we are doing now in Nordea. And then as the previous panel on target setting, key to be able to, having models and frameworks and processes, that's one part of it. But we have to set the direction so we know which businesses to say no to, and also how to set the expectations long term and set those targets together with the customers and understand what are the expectations on them, what are the expectations on us, and together how do we set that path going forward. If we do that successfully, then we will manage to shift the entire portfolios, but we will also be able to have a just transition, because that is important. It's rather easy to say remove all fossil, but it's not that simple actually. We have to take the entire societies into account. And that's very interesting, and I think very short end note to be mindful of time. Like Catherine said, it used to be enough to have a green financing strategy and perhaps have a strong development on green bonds. And we all know that the green bond market is exploding, but that's not enough. It's still a fraction of the total. I think it's maybe 1% of the total portfolio on a global level, or even less. And what we need to do is to be innovative in transition products with clear demands and clear expectations to be able to shift the large part of the financing portfolio and not just the green part. I think that's, my time is up.
Well, thank you so much, Ivan and Anders, and to all of you who are here with us. Obviously, we have a short amount of time with all of these wonderful speakers, and they have a lot more to add. So we will be taking your questions and creating a follow-up Q&A document, and we will lean on our speakers to respond to that. So you really do get to hear from them. It'll be the written word rather than the verbal word, but we thank them for their time joining us today, and we thank all of you for being here. So now we want to tell you a little bit more about Climate Safe Lending Network and who we are, what we do, and how you can join us to be part of this really important action. So I'm going to invite Lydia to join me again and tell you a little bit about what she and I work on.
Lovely, thank you, Becca. So yes, there are several initiatives as part of the Climate Safe Lending Network, and the Climate Safe Learning Lab is an initiative that is specifically for those working within banks and lending institutions across North America and Europe who are leading the climate finance agenda internally. And we've heard a lot about leadership. We've heard a lot about the internal institutional culture dimensions of this work. And if we could just go back one slide, please. I'd love to introduce you to the methodology that we use to approach the Climate Safe Learning Lab. So we know there's a lot of activity going on around methodologies, around strategies and frameworks, and the work that is required to do the technical aspects of climate finance. Now, what we've really been identifying there is a gap in networks that support those who are trying to implement these strategies from within banks to identify what are the organizational, behavioral, cultural barriers that they experience internally in trying to do that work. So this is where the Climate Safe Learning Lab comes in. This is a confidential, pre-competitive peer learning environment specifically for bankers. Not just those in sustainability roles, it's across the board from risk, legal, corporate strategy, relationship managers and beyond. Creating space to identify what are some of those levers within this iceberg that you see on the slide that are potentially barriers, and on the flip side also enablers to really rapidly accelerating that agenda. So Climate Safe Learning Lab takes a complex human systems approach, and that's what you see on the screen here. We do this through virtual convenings, bringing together specifically bankers in confidential environments, followed by small group peer coaching sessions, again happening virtually across both sides of the Atlantic, to come together to rapidly troubleshoot in real time some of these challenges to start overcoming them together. And thirdly, then we codify these insights in an anonymous way in agreement with the confidentiality that the entire initiative is set up around, to then share with those external stakeholders that share the common goal around climate goals. To help them understand what are some of the things that are happening on the inside, and how can external pressures like investor pressure, like customer pressure, then be utilized to also support that movement forward. So if you work within a bank and you are wanting to influence the climate agenda in some way, in fact, if you already are, then we'd love for you to join us as part of the Learning Lab this year. And you can see the URL on the screen to visit and find out more information. So I'm going to hand over to James now, who's going to share a little about 2 other initiatives as part of the network. James.
Thanks, Lydia. So in terms of the overall climate safe lending network, this is about a network. This is a network approach, and as Lydia sort of explained, we have something for the community of individuals working within banking institutions, the Learning Lab. We also have an initiative amongst this group loosely called influencers for some of the shareholders, the shareholder networks, corporate clients who are recognizing that their financial footprint matters, high net worths and foundations, some who are working with retail client networks, to see how can they encourage and help this shift. What is their agency within the set of relationships they hold? What also are their needs? So looking at the corporate clients from businesses who are wanting to transition to net zero and to get on a resilient path. What is it? How can they express their requests to banks in the most effective way? So we're trying to bring together groups who are already working on this, and we've had some very good conversations so far. And it's all about being able to leverage different conversations so that individual organizations learn from one another. Likewise on policy, so there's a vast range of stakeholders here, experts, the banking institutions, regulators, civil society organizations who understand the relevance. There's a lot of policy which is happening in Europe, in UK, in US, different landscapes, but similar strands of issues, trying to articulate what are the interventions which are going to most helpfully change the system in the right direction. And this is about a network which then can cross-pollinate these ideas, and using the harvested learning from within these different initiatives across the network, we can connect, we can learn, and we can have some of these systemic discussions so that all of our insights are just that more sophisticated. We can bring to our work, no matter what our context, that broader sort of peripheral vision that's going to be able to help in leadership and being able to transition some of the cultural aspects. We've tended to be between North America and Europe, UK, but we welcome, and it's great to see the diversity across continents, and this issue is obviously far broader than those two continents. We want to think about how we can have that focus to be able to radiate those insights further, and would really welcome everybody being able to join the network, to join these initiatives, and we'll be following up with you in the practicalities of how you can do that.
Thank you, James. In terms of those practicalities, you'll see that there was just a link posted in the chat here, and that link will take you to a survey where you can indicate your interest in joining some aspect of the network's work or learning more about it. And so we would love to follow up with you, and we won't know you want us to unless you fill that link. So we would love for you to literally take the time right now. You've been doing lots of listening, so now it's your time to take a small action, which is to click on that link and fill out the survey. I'll give you a moment to open that link. And click away. And as folks are working on that, James, I know we didn't have time to get to the second Q&A, and we really would have loved to do that, and we'll certainly be following up via written word with folks. Is there any point you wanted to make or any question that came up that you want to answer right now?
There's a few I've been trying to pick up in the Q&A, and we will answer all of them and make sure to give them due attention. But I think that there's quite a few questions which really there's a strand running through of, is there just a framework here, or is there something which we can kind of pick up? And the simple answer is that there isn't right now. But what I think to kind of specifically kind of give some of my impressions from the interactions I've had over the past years is that there's no substitute really to a group of active people who've got the kind of the relevant experience and will to do something, sharing those insights and being able to try and turn themselves to solve this together. Some of the initiatives, and there's quite a few on the call who've been involved in Partnership for Carbon Accounting Financials and other things, there's a real pragmatism in the intention of coming together to try and work things out, to pick up some of the ideas and learning and models and suggestions without it being dogmatic. And I think that actually has got a normative effect as we sort of start to articulate that and spread that round as something which can be done, which can be really quite energizing. So that's something which has kind of come through quite clearly. And I think someone else was asking about the litmus test for when do you know you've really got there. And I think there's probably a scientific answer, but the unscientific answer is really sort of, well, in the olden days you'd say, well, what's the first few conversations you have with people as you go through the front door? We're not so able to go through front doors right now, but I think that it's about being able to infect this sense of purpose really at every level of the organization. What we're doing here at Climate Safe Lending is this is action at every level. So it really involves the personal, the institutional, and the whole financial sector. And I think that engagement and that degree of connectedness in thought and action is really what we're trying to what we're promoting, and what I'd sort of sense as being that's the kind of the litmus test as to when you're really on the right path.
Thank you. Really important to engage the whole system. Wonderful. Well, we really thank each and every one of you for being here. This is a critical, urgent issue. It needs all of us, and there's no time to waste. So we're really glad you took the time to be with us today. We will be following up with you, and we really look forward to your questions, your comments, your disagreements, and your engagement. So really thank you for your time and attention. Take care, everyone.